is when you fall below that investment grade, the double B plus. Once you fall, the triple B plus, or triple B minus. The double B plus is non-investment. So once you fall below investment grade, below triple B minus. So when you go to double B, right? So it goes triple A, double A. Then they're just institutions that can't hold you. Like you're not investment grade. So they like pension funds, or they can't put them in their portfolio.
So you go to being like rated as speculative rather than investment.
Exactly.
And so, like, just interestingly, what would a MicroStrategy bond be rated at? Do you know?
They haven't been rated well. So I think they just withdrew the ratings is what they did.
I see.
So that's the issue for them. But it trips over junk when you hit when you're in the B rating.
Okay.
Right. So it's like anything is like that non-investment and it's speculative. That's kind of junk area.
Okay.
The difference between, and this is where people kind of get mixed up. The difference between the important difference between junk and distressed is like once you hit like triple C like minus then you're junk, meaning you're not paying your interest payments. You've tripped interest payments, and now you're declared junk and distressed. So you're in default. You're in distress. So you've gone from junk or speculative junk to distressed, and now you're
in the death spiral.
You're in deep trouble. So people need to understand with stocks is like they're at the bottom. They're at the very bottom. So if you're buying something that a company that's debt is distressed, that means that if the company goes bankrupt, the stock is likely worthless.
Yeah.
Okay, so back to buying distressed bonds. So what you would do is you're going to determine where what the probability is and how much you would get back and all that. But you're really looking at, when you're a distressed investor, you're digging deep into balance sheets and obligations and other debt and all these, anything that may come before you as a claim to those assets if you're going to liquidate the company. Likely the one thing that will come ahead of you is bank debt, which is totally secured. And, it's like they got this line of credit from Citibank or something. That's got to be paid first.
Yeah.
But back to TWA. So we, agreeing that our debt issuance is out of control, and we clearly must print a lot to keep this whole charade going, because we're not making, we're not covering the debt we're issuing. So it's clearly a problem. So, and they've said that in their issuance.
And I assume this isn't just a US problem, because this like sovereign debt crisis is happening all over the world. So are all the sort of nation states getting their debt downgraded?
No, no. I think Germany is still AAA.
Right.
So it's the US is getting tagged, and this goes into the whole Triffin dilemma, which I'll be talking about with Lynn and Mark Moss on Wednesday on the Nakamoto stage here. But which is, if you're the global reserve, and those are all over the place. There's so many of them. But with this, it's like, okay, you're getting a credit default swap on all sovereign bonds of the U.S. So if the U.S. Treasury trips a payment, well, that likely triggers the credit default swap to be paid out.
So you're betting on default, essentially.
You're betting on default, whether it's technical or not. And so you're paying, as of now, or as of last week or a couple of weeks ago when I wrote that article, it was like 59 cents. It's $59,000 per $10 million of credit default swap. So these things trade in chunks. Like you and I couldn't just buy a credit default swap for our PA, our personal account. Like you're trading tens of or hundreds of millions of dollars for these swaps. So that legal contract just says that if they default, technical or not, then you get paid out. So pretty good. Sweden, 13, Netherlands, 13, Switzerland, 11. Okay. Japan, 19.
Even though Japan's going through an absolute
Correct.
meltdown.
Isn't that interesting? Okay. So, but they have demonstrated they will
Backstop everything.
backstop every single thing.
Yeah.
Exactly. So Australia is 13.7. Okay. So what about the weaker countries in Europe, right? So what we call the pigs, Portugal, Italy, Greece, and Spain, which were back in the great financial crisis, they were all in distress.
Yeah.
And so Greece was kind of forced to restructure their debt. So
Greece is like the economic basket case of Europe.
correct. Right. So you would think, those would all be worse than the United States, right? And forcing us to, continue to print and have these massive deficits. And the issue is that I believe the world is catching on. And we saw sparks of this. And you and I talked about this, I think, 18 months ago about the BRICS nations. Mm-hmm. When we were talking about the game theory of adopting Bitcoin as a strategic asset to secure your bonds with. And, that was when the people were kind of talking about, BRICS is going to come out with their own currency. It's going to compete with the US dollar. And that's not really the case. What's happening is that the BRICS nations want to get away from the US Treasury, meaning the Treasury bonds, because they see how, number one, then when that they're doing it, well, now you're not doing business in dollars. So they're not cross-border isn't the dollar. Now it's these other currency that they're trusting.
It's you brought up bit bonds before. The really interesting thing there would be to see what they would be rated.
They would be,
because presumably they'd be AAA.
Yeah. Well, I guess, presumably, but it's a long way down the line.
Yeah.
They won't have a rating for a while. They'll be with MicroStrategy with no rating for a while.
Even if the US issued bit bonds.
Yeah. Well, it really depends on how they do it and how they secure it. And honestly, Danny, it really depends on where the understanding of Bitcoin is globally at that point. Because it's so misunderstood right now.
Totally.
And so that's the big thing. Going back to institutional investors, that's the big thing. Yeah, we got the ETFs. Everybody has to get these dollars that are being debased rapidly, and that's the privilege. It's structural. And it's now people are looking at it saying, hold on a second, time out. Is this really the way we want to, do we really want to own these?
Yeah.
Truly. And so, Michael Howell argues that he just put out a newsletter this last few days, and he argues that the 10-year should be trading above 5% already. It's at 4.5%. But he's like, the 10-year should be trading above that because the issues that we have are they're actually being
because you have both inflation and asset prices
or grinding or falling. Yeah.
And so why do you see that as like the coming scenario?
Well, I don't know if it is a coming scenario. It's one that worries. It's one that I'm concerned about, and I'm watching economic indicators closely to see if we're getting anything. But Danny, every time we get an indicator, it kind of conflicts with the last one. So it's like there's no clear signal that the economy is rolling over or grinding lower. There are signals that it is, but there's a lot of noise around it too. So if you look at producer price index, which is it's typically one of the leading indicators that you can see what the producers are paying for goods, and then they're going to use them to manufacture or whatever, to sell to companies for them to. But that's a scenario where if you get into recession, it's kind of funny, Danny, because now we're running such high deficits, fiscal deficits, and you get into recession, it just makes the deficits wider. Mm-hmm. So normally you would see this rush into the 10-year treasury, and the 10-year treasury would go from 5% or 4.5% down to 2.5% or lower, because it's a flight to safety asset. But in the scenario that we're talking about, which is why we're seeing term premiums, is, oh God, if we get into a recession, that means that the deficits are going to be even larger. There's going to be even more 10-year treasuries, and they haven't termed out the debt yet. So then what happens?
So right now, I've not actually looked at the price today. Bitcoin's at like 109, 110K or something. How do you see like the next 12, 18 months playing out for Bitcoin?
I think it all has to do, and I this is where I do agree with Michael Howell, collateral to secure that position with your lender, and so that draws liquidity out of the market. So when you see high volatility, that's not good, especially in bonds, because bonds are the base asset to borrow against in repo markets and shadow banking repo markets, not just with the Fed, and so that's bad. When you see the MOVE index get higher,
I was
that's
talking
bad
to Jack
for
Miles
liquidity.
about this. Yeah.
Yeah. So, and that's the issue, right? And so, I think Jack and I have talked about it. So that's the issue. And that's part of the calculation. Okay. So this goes back to your question. What do I think is going to happen with Bitcoin this year? Well, I still think that we're expanding liquidity, and you can see it. You've seen liquidity expanding recently. And so, and Michael's studies have shown that liquidity goes in 5 to 6 year cycles. The last cycle bottomed out, and it's going to be 5 years coming at the end of this year, I believe. So his point is that liquidity is going to peak at sometime in the first quarter.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support.